2,000 to 6 or 7,000 per capita income. This is a slightly less risky though. Once you reach a much higher level of per capita income, then you need much more structural improvements for sustaining that growth further. Equity is reasonably attractive, especially at this point. Indian equity is much more attractive for, let's say, over the next decade.
So the reversion to mean concept happens over a very short period of time. In the market, there is some natural law which corrects it.
Whether it is a company or a country, they have certain sustainable levels of growth, and the sustainable level is based on factors like your capital productivity, your ability to invest in the economy. When the level of transparency in an economy is a bit on the lower side, one of the natural corollaries is that large part of the savings pool of the population gets into asset classes like gold and real estate.
So this is equivalent to when you buy a stock, I read somewhere, just write on a piece of paper why and mine this stock.
An investor should have a consistent investment philosophy.
If a new gentleman or a lady approaches you, no finance background, she wants to work ultimately as a fund manager with you, and she's from liberal arts, will you consider? The equity gurus, the chief investment officers equity of various mutual funds. These are the people who manage your money on a day-to-day basis, where fund managers reporting to them. And I mean, who better than the CIO Equity to tell you how to manage equity and how to maintain your stock portfolio. So I have today with me, I have Janaki sir. Janaki sir, let me welcome to the CIO Panel podcast.
Thank you, Nirav. Pleasure to be here.
It's my pleasure to, have a tea talking with you. And let me introduce you formally, and then we'll take it forward.
Sure.
So, Mr. Janakiraman, right, is the Chief Investment Officer at Equity. And sir, let me congratulate you. Till yesterday, you were Deputy CIO Equity, and today you are Chief Investment Officer Equity. So, congratulations.
Thank you.
It's my privilege that on this day I am interviewing. So you are the CIO, Chief Investment Officer Equity for Franklin Templeton Asset Management, that is Franklin Mutual Fund. You are responsible for overseeing all local equity funds. So by local, it means domestic. Whatever funds are putting money in India, your responsibility includes mentoring all the portfolio managers, apart from continuing to be a portfolio manager yourself. Sir, you have been an in the investment management industry since 1997. And you are with Franklin Templeton since 2007. And prior to joining Franklin Templeton, you were managing the investment corpus for Indian Syntex Group, which is a Chennai-based privately held group of companies. And before that, you were with UTS Securities.
Right.
By education, sir, you are a CFA, Chartered Financial Analyst.
Again, thank you, Nirav. Pleasure to be here.
Pleasure is mine. Sir, and I have a bad throat, Janaki sir, today. So please don't mind me, and I request the viewers to don't mind my bad throat. So let us start from the ABCD. Why invest in equity and why invest in Indian equity?
Few things, Nirav. One, equity returns equity being a slightly higher risky asset class, equity returns are generally better than some of the less risky asset classes like fixed income.
Yeah.
So for any individual investor or a household, he should have an asset allocation mix where a slightly higher risk, higher return product also finds a reasonable role in that asset allocation. That is the reason for having equities in general. Now there is a much more compelling reason for having Indian equities. And the reason is that post-91 liberalization, we all know about the way in which the growth has picked up momentum. Actually, from 91 to 2022, after 30 years, still if you look at our per capita income, it's about $2,000, $2,500 or so. Now, we have reached a point where the initial hard work has been done in case of this evolution of per capita income. Empirical evidences across the world indicate that up to somewhere about this $2,000 to $3,000 per capita income, up to this level, mostly the basic demands of the household expenditure is met. These are things like shelter, food, things like that. I think beyond this is the tipping point above which the spending in discretionary categories begins to increase
The
quite.
disposable income of the family increases.
So things like better quality healthcare, travel, education, things like that. Perhaps savings also increases. The higher savings, in fact, like it can eventually accelerate the growth much.
Yeah.
So I think we are in that position, and this 2,000 to whatever 6 or 7,000 per capita income growth. This is a slightly less risky growth. Once we reach a much higher level of per capita income, like where, for example, China is today, then you need much more structural improvements for sustaining that growth further.
Okay, so this is the low-hanging fruit.
Exactly.
The honeymoon period where the per capita income of a country is around 2.5-3,000 crore USD, and it is expected to increase to 6,000-7,000. So this is a honeymoon period where there is J curve that happens in many goods.
I really don't know whether there is going to be an acceleration in growth. The point that I'm trying to make is the level of uncertainty in the growth between a 2,500 and a 7,500 is much less when compared to, let's say, the challenges in the level of uncertainty from 7,500 to 15,000.
Okay. The uncertainty in the economic growth.
Uncertainty in the economic growth, which means that as an equity investor for you, less uncertainty means lower cost of capital, lower volatility. So which means that your returns can be on a risk-adjusted basis much better in this phase.
Okay.
We have also seen how some of the other countries have gone through this phase. So the playbook is visible when you look at some of the other middle-income countries who have already traversed this path.
Okay.
So which is why I think that equity is reasonably attractive, especially at this point. Indian equities look much more attractive for, let's say, over the next decade or even, I would say, 2 decades.
And where in the future, in which year do you see, I mean, you cannot pinpoint exactly, when we would be reaching that 7,000 per capita level?
I really don't want to put a
figure
to this. I would say that in terms of real growth, the per capita income should continue to grow at somewhere around that 6%. And if you compound per capita income at 6% and keep inflation at reasonably acceptable level in a reasonably tight band, I think then the next 20 years equity returns also can be as attractive as what we have seen in the last 20 years.
Or if not equal, it might be better also.
Even if it is equal, if you ask
then
me,
it is still a very good,
extremely positive outcome, I would say.
So Janaki sir, tell me, this concept of reversion to mean, does it not apply to equity returns and economic growth?
Reversion to mean, I would say that in this context, applies to things like valuation.
Okay.
For example, if you look at equity returns itself, the value of the equity is essentially the value of the underlying business.
Yeah.
And if the underlying business keeps growing at a steady pace, then the value of that business also should keep growing. So then there is no excess in that. Excess happens, reversion to mean happens only when there are excesses away from the mean level.
Okay.
And these are typically factors, metrics like
reversion to mean happens only when there are excesses. If something is growing at a steady pace, it can keep growing for a very long period.
Even the steady pace looks steady only when you look back, especially over a fairly long period of time. Take the case of our own equity returns for the last 20 years.
Yes.
I think the CAGR maybe, if you look at Nifty, maybe about 14-15%.
Yes.
But if you look at each of those 20 years, we had returns significantly higher than 15%.
Or lower.
Or lower also.
Yeah.
So I would say that is where the reversion to mean happens. If you see 3 or 4 years of returns which are well above the trend line,
then it brings it back to normal.
Yeah.
Oh, okay. So the reversion to mean concept happens over a very short period of time, and the market, there is some law, natural law, which corrects it, right?
It's not a natural law in the sense.
It's the law of the market, the law of the jungle, you can say. It's not a law like physics. but it is the law of the jungle. Something happens which brings the valuation down to normal levels.
Yes, and the fact that many of the economic entities, whether it is a company or a country, they have certain sustainable levels of growth. And the sustainable level is based on factors like your capital productivity, your ability to invest in the economy, the level of savings in the economy. So that will give you a trend line.
Yeah.
In the short term, in the short term, can the number be much different from the trend line? Yes.
Yes.
But if
in the long run?
Yes. In the long run, I think the numbers come back to the trend line, and the correction process is what we call as reversion to mean.
Yes. So Indian equity returns have been very good if we compare to any other market in the world. The only person who comes second or first is the US equity market. I don't think anywhere in Europe or anywhere in Latin countries or anywhere in Asia, any other equity market comes close to what the kind of return that Indian equity has given over a very long period of time. That is where my question was. That one matrix scares you. If you say what we did in last 20, we can almost replicate it in the next 20. So we'll have a 40 year of a very good equity run.
It's not too long. Keep in mind that we also have the advantage of a low starting point in terms of per capita income.
Oh, yeah.
After this 30 years of post-liberalization growth, we have reached per capita income of 2,500 or thereabouts.
Okay.
It is still significantly less than, for example, China. And 1980, as many of the reports cite, India and China were more or less at the same per capita income.
Yes.
So our runway is much longer because of the starting point. If, for example, our per capita income were at 5,000 today, then I would not be so confident about the next 20 years return. Still, it may happen, but the level of confidence may not be so high.
Okay.
But since the starting point is quite low, going back to that analogy that you made about low-hanging fruits, there are enough low-hanging fruits to sustain this 20-year returns.
Okay. So not talking stock specific, but if we talk sector specific, I am sure the sectors that you bet on when the economy went from 500 per capita to 2,500 per capita would be different from what you're going to bet on from 2,500 odd to 7,000 odd. Can you throw some light on that?
When we are discussing about this this tipping point, we made a comment that below the tipping point, bulk of the expenditure was in basic categories.
Yes.
And above the tipping point, then the expenditure is more towards...
So roti, kapda and makan was your emphasis in the initial period, and now it is way beyond that.
Way beyond that. So now I think increasingly in many of these categories, premiumization will become a key driver of competitive advantage for businesses as a driver of profits. So, for example, the same staples as a category may continue to do well, but then the product basket within those staples, the level of premiumization may be significantly different in the next 20 years compared to the past.
So we can say brands, other things being equal. So please have coffee. So other things being equal, brands will do better than commodities. One example. Then leisure travel would do better than economy travel, or upper class will do better than things like that.
I would not say upper class will do better. In fact, like one of my expectation is that we still have a fairly skewed consumption pattern in India. The top 15 or 20% of the population, they account for a disproportionate amount of the consumption.
Yes.
And as the growth continues, as the growth democratizes the spending pattern, as the benefits of the growth percolate to the population beyond that top 20%, I think then you will see the growth gathering more momentum. So I would wish that in the next 20 years, the consumption pattern is much more distributed across the population. Than what we have seen in the last 20 years. That will make the growth, like I said, more well-founded. In fact, it will lay the seeds for extending this growth even beyond those 20 years.
Oh, wonderful. Thank God.
See, end of the day, we have such a large population that once the demand from such a large population kicks in, I think then it gives you a reasonably long runway of demand.
I think India has an entire Europe within it, right? You have different kinds of economy within India. So premiumization, you said, is one concept, one theme which one can play. Another would be financialization of savings.
Definitely.
That's a very important theme. I mean, without the support of the financial industry, the banking sector, economy cannot move. And the other financial services sector outside of banking also, considering the per capita consumption we have today, they are also expected to do better.
Yes, and when the level of transparency in an economy is a bit on the lower side, it's one of the natural corollaries is that large part of the savings pool of the population gets into asset classes like gold and real estate.
Yes.
But once the level of transparency in the system keeps improving,
Then they come to financial assets.
yes. So, and you know very well that as far as our households are concerned, still a large part of the
Net worth is in gold and physical assets, gold and real estate.
I think once they gradually get into
Yeah.
financial savings,
Yeah.
I do expect that the ability of the domestic households to fund investments, which will in turn accelerate our growth, I think that will become much more pronounced.
Wow. So that's a very powerful and strong case for putting money in Indian equity and giving it to fund managers like you.
Absolutely.
Okay. Now throw some light. You just come two of your equity funds. Will not go into product specific, but two of your equity funds are completed 30 years. You would be having a very good idea what was the CAGR they gave, and how did you manage a scheme for 30 years? What was the initial AUM in the first 5 years, let's say? How has the AUM grown? And if you kept getting as a fund manager more and more money in your scheme, which I think is much difficult, managing a smaller AUM, sir. You are a CIO Equity is much easier than managing a much bigger AUM, and especially if you're getting money at an increasing rate. So how did you manage that? What was your initial AUM in the first 5 years? What is it today? What is the kind of CAGR these products gave? And how did you manage incremental amount of money, and where and how long you can manage? Let's say your AUM multiplies and goes 5 times in the next couple of years.
Nirav, I've been, like you remarked initially, I've been with Franklin for the last 16 years. And I've been managing these funds since about 2010 onwards.
Yeah.
So the growth has been reasonably steady. There have been some spurts in between. But for example, in 2009 or 2010, now we are talking about the immediate aftermath of the global financial crisis.
Yeah.
At that point, definitely the AUM was quite small.
Yeah.
Probably the AUMs were maybe about a 10th or 15th of where they are right now.
1/10, 1/15 of what? In 2010, you were saying?
2009.
9. So around 13, 14 years back,
Yeah.
you were 1/10 of the AUM you have today. Okay.
And subsequently, it's been a combination of both NAV appreciation as well as flows. Flows have been quite, like I said, reasonably steady for Franklin. We are well established in this country.
And your parent, I mean, we'll take 1 minute. Your parent is Franklin Templeton based in US, okay, which has been founded by Benjamin Franklin? Or was he instrumental? How do you get the name Franklin?
I think Ben Franklin, no, so he was not clearly the founder of Franklin Resources, but one of the qualities that Ben Franklin used to espouse, used to promote was savings and thrift.
Thrift, yeah.
Yes, savings and thrift. So I think here I'm just making a educated guess only. I think like since Franklin Resources, which was formed by the Johnson's family, they thought of mutual funds equity investing as a savings-oriented business. I think they thought Ben Franklin as a brand ambassador can be a perfect fit. And this was...
that is where the motivation comes from.
Yes, I think this was started very long time back. This is my understanding. So that is the link between Franklin and Ben Franklin.
Okay. And Ben Franklin was my guru's guru. So my guru is Warren Buffett, right? And Warren Buffett's guru was Benjamin. So the man who wrote The Intelligent Investor Okay, and his guru was Benjamin Franklin. Sometimes the words don't come to your mind.
Ben Graham to Ben Franklin.
Graham to Ben Franklin. Yes, his guru was Ben Graham, and Ben Graham used to adore Benjamin Franklin.
Of course, Benjamin Franklin was a polymath.
He was a polymath. Yeah. So was Charlie Munger, who unfortunately expired a day back. So he was also a polymath. I have become a very big fan of liberal arts. So tell me one thing: if a new gentleman or a lady approaches you, no finance background, she wants to work as an analyst or ultimately as a fund manager with you, and she's from liberal arts, will you consider her?
100% yes. So what we look for in people who want to join our organization is a high level of curiosity.
Okay, wonderful. So I will take the first box, sir.
Need not be necessarily school.
How do you quantify that, sir?
It's a bit of a subjective assessment.
Yeah.
So there is no written
No set
examination.
formula.
Yes.
You will just judge the person based on the conversation.
Yes, based on, let's say, conversation.
But that is the first thing that you said, huh? High level of curiosity.
See, in this business, Nirav, I think we need to have a high level of curiosity.
Yes.
So that is the key.
Okay. What are the other points?
Key essential metric, and the fact that he or she is not schooled in that traditional financial theory
Is a advantage.
I would not hold it against him or her.
Okay.
In fact, like if you look at our own organization, every now and then we ask ourselves a question that are we allowing groupthink
Yeah.
to creep into our organization?
Yes. We'll talk about groupthink. You said we'll talk about institutional imperatives, sir. Okay. Yes. So you want, if you have 10 fund managers below you, you want them to not think alike. You want 2 or 3 heads who should think independently of the others, so that the others' views do not get. But sir, let's say if I'm a newbie and I'm reporting to you, I'll get influenced by you, right? I'll get enamored by you if I value your skill and talent, and I look forward to you. How easy it would be if I'm a new fund manager, just joined today, to tell you, sir, I don't agree with you on this particular stock that you have picked. I have a different opinion. Will I speak? Do you have that kind of a culture?
Yeah. So that, yes. So that is where culture comes in. And one of the advantages of Franklin, and of course I know Franklin very intimately in the Indian environment.
Yes.
But in my infrequent interaction with my global peers,
Okay.
I realized that it is more or less the case in the global organization as well. It's a very flat, open organization.
Okay.
We don't have too much ranks, especially within the investment team. Very collegial culture.
Is it so?
Very eclectic. We spend a reasonable amount of time thinking about long-term events which may not have much impact in the short term. So these are free-flowing thought processes where people have people with a different opinion. They feel free to actually
Voice their views.
Voice their views.
Can an analyst walk into your cabin anytime?
Of course.
Okay.
Yes. And so that way it's an extremely open organization.
Okay.
And hierarchy does not account for too much rigidity.
Okay.
Like I said, it's a flat organization. And the other thing is, there is a joke that Franklin is a bit like Chakravyuh.
Acha.
Once
you enter.
Exactly. So people who join the organization,
They like the culture.
Yes, they like the culture. They tend to stick with us for a long time. Pre-COVID, I had about 10, 12 years of experience, and I was relatively a junior in the team. So within the team, you had many people who had even longer experience.
Okay.
So if you have such a team which has worked together for a fairly long amount of time, then that hierarchical rigidity will not find its place.
Understood. Okay. Now let's come to stock picking. Let's say I'm a newbie in the world of stock market. I'm a young guy doing some finance course somewhere, undergrad level, and I want to start picking equity stocks. What would be your suggestion? Somebody 30 years with 30 years of experience giving a suggestion to a new guy who might be a fund manager one day but has no experience. What are the do's and don'ts?
every investor has to go through his or her own learning curve.
Yes.
And I don't think an investor can, of course, mathematically possible, but logically, every investor has to go through that initial phase. There will be somewhere there will be a set of inevitable mistakes.
Yes.
Preferable route for a person who wants to become an investor later in his career, become a professional investor, is that start early, start with a lower corpus, and experiment with your ideas, and keep honing these ideas by reading. This is in fact one of the requirements that I insist from my own team colleagues also, that we need to keep reading and keep upgrading our skill sets and capabilities. I don't think we can rest on what we learned.
Past laurels.
Yes, laurels.
Yes. It is the most dangerous thing for an equity person. The moment you think you have arrived, the market will show you that you learned nothing. I think market is supreme, right?
Market teaches you humility very effectively here.
All people of your rank and file, your caliber I've met, all of you are so humble, right?
Yeah,
is it the market which is humbling you time and again? Why are you people managing the kind of money? Like, what is the money you manage? It is directly under your.
Right now, I manage. Like you mentioned, those 4 schemes put together will be about roughly 40,000 crores.
And as a CIO equity, the total equity AUM would be?
It will be about roughly 80,000 crores.
So somebody who's overseeing, who's managing 80,000 crores and such kind of humility, I think only market can.
Yeah. 25 years in the market.
That's why. But then that phenomena is not there in the US equity market. So I was talking to somebody, an ultra HNI client today, and I said, with your kind of background and your kind of performance. And you didn't mention what the 2 schemes that completed 30 years under the Franklin umbrella, what was the approximate CAGR?
The mid-cap fund, which has completed 30 years, if I remember the number right, that is about 17%.
17% CAGR for 30 years.
Actually, I did the number for the last 20 years. 30 years, I'm not sure. And the same 20 years, the number for the large cap product, that will be about 15%.
15% for your flexi cap, right?
A blue chip.
20%. What is the CAGR you said, sir? For
15%.
15 and 17. Okay. We are almost matching Warren Buffett's performance. Over the last 10 years, we would have beaten.
But do keep in mind that
he has done it for 65 years.
And this is the rupee return. There you're talking about a dollar
return. Yet, I mean, he's in his market, you are in your market.
True.
So no comparison, right? In your home market, you have done that. And I was just talking to an ultra HNI client today and I said, the kind of fund managers we have, people like you here, you would be demigods in United States with this kind of performance.
I wouldn't want to go to that level. But again,
and then they fall, sir. And then they fall. The media paints them as demigods. I know you're too humble to admit it. And then they fall. It's better the kind of humility and the humbleness that people like you have. I think, in fact, if you ask me as a distributor, that's the first criteria I look at. You said you look at curiosity in an investor. Of course, that goes without saying. I look at humbleness. In the world of money, our Shastras say Lakshmi Chanchal hai. So if I believe I've arrived in the scene of fund management and I can't go wrong, the next moment I'm going to go wrong. With due respect. Okay, sir, in the world of equity, when I make a portfolio, there are two school of thoughts. One is somebody like Peter Lynch, one of the most successful mutual fund manager in the world, who was given a phenomenal return, higher double digit, late 20s, and who was given that performance with a long tail portfolio. And then there are certain school of thought who say there should be a concentrated portfolio. Some people take it to the next level and bring it down to 10 stocks. But I think anything below 20, 22 would be concentrated, right? Anything above that, 30, 40, 50 is long tail. What's your opinion on this? Is the jury out or is it not?
You see, the answer, there is no single answer for this. If you answer the question from different perspectives, the answer will be a bit different.
Okay.
It also depends on, so one of the perspective is, in what cap category are you investing in?
Okay, so let us go small, mid, and same question for small cap, then mid and then large.
Yes. So in a small cap category, especially if you're an institutional investor, the portfolio will tend to be a bit more fragmented.
So long tail would be better than concentrated. Other things being equal.
So the question is, there are practical reasons, and then there are also the
liquidity issues and all that.
Yes, and there is also a desire. For example, today in my small cap portfolio, I have about roughly 75 stocks. Am I comfortable with this? Perhaps no. I would prefer the portfolio to be actually a bit smaller than that, where I think the top 20 holdings, which express my convictions reasonably well, I think those top 20 holdings can be a bit on the higher side.
And your highest weight would be in your small cap portfolio?
Today,
top weight could be how much?
The small cap number one holding will be about 4.5%.
Okay, that's where you go. And by regulation, you are allowed 10%.
Correct.
Okay, but you're choosing to be 4.5 because if you're 75, right?
Correct. The other part of this reason for this tail is that, like you said, practical issues like liquidity. Stocks on the way in, on the way out, the process takes a bit of time. So to build a position in a small cap stock, it takes a bit of time.
Okay.
Same is the case for
mid cap.
Exiting that portfolio also in small caps.
Okay.
So which is why small caps tend to have a bit of tail.
Okay.
And the tail will be shorter in the case of mid caps. Last 20 years, mid cap as a category has evolved phenomenally.
Yeah.
So today, the mid cap, the upper end is almost up to about 60,000 crores, and the lower end is about 20,000 crore. So mid caps are reasonably liquid, much more liquid than small caps.
So in mid cap, you would prefer a concentrated portfolio over a long tail?
I prefer a more concentrated portfolio compared to a small cap.
So 75 will come down to?
Probably 50.
Still 50?
50.
Okay. And large cap?
And large cap, I think then the portfolio count can come down even further.
To 30, 35 or 25?
I would say 35 to 40. And there are, like I said, there are no single answer to this question. And even for a large cap, for example, what is an optimal number? Is it 40? Is it 30 or is it 25? To some extent also depends on your investment philosophy. For example, some of my colleagues also like to have contrarian positions. And when you take contrarian positions, at the outset, it may not be very clear about the eventual outcome. So you tend to actually diversify the risk across some 3 or 4
So
positions.
contrarian portfolio by default will have a long tail?
Slightly have a longer tail.
Okay.
So those things also come into the picture. Okay. So the question has to be answered from perspectives of cap, from perspectives of investment philosophy. So like this, there are multiple perspectives. So, and there are...
The jury is still not out.
Yes.
We cannot say one is better than the other.
Yeah.
Whatever suits you.
Whatever suits you. Second, ultimately, it should be in line with your investment philosophy. It should actually not impact the effectiveness of that philosophy. Bottom line is that.
Okay, for a scheme, fine. Okay, there was one very important question. Okay, sir, when I individually, in my personal capacity, if I'm managing a portfolio, even in your fact sheets and all, we give portfolio weights. The portfolio weights are calculated. It's a very basic question. Still, I'm asking for some of the investors. The portfolio weight is calculated on the market value and not on the cost. Should it, I mean, as a fund manager, you are in public eye, I understand this is an individual's question. Like, sir, Warren Buffett has Apple as the biggest. And I had asked him this question also. Apple is the biggest holding in Berkshire Hathaway. Sir, that is around 48% today of his investment portfolio. So the biggest investment portfolio in the world has 48%, 45% in one stock. And when that question was asked of him, he said, no, it is not a very big holding in my portfolio. I don't believe it is a big holding. I don't know why he said that. And should we look at the portfolio weight? One, should we look at the returns I've got on a stock? Because if I'm evaluating a stock today, whether the stock gave me 0 return in the last 3 years or 200% return, is it relevant?
2 ways to answer this question. From pure investment perspective, it is not relevant.
The weights or the returns I've got
The historical purchase cost
is irrelevant.
is irrelevant when I am evaluating a business today. So when I decide to continue to hold on to the business, effectively, I am buying that business.
Every day when I'm holding it, I'm also buying it. Okay.
And when so which means that in that decision, I should use the same framework, same logic that I use for buying a stock which is not there in the portfolio.
But then, sir, when we ask this question to fund managers like you, let's say stock, everything is okay, the business is good, valuation a bit high. Valuation is a bit high, okay? So we get this answer, hold it, but don't buy more. So the decision is different. The decision is different if I'm holding it vis-a-vis if I have to buy. Why?
Impact cost,
Okay.
which is transaction cost.
Capital gains and the transaction brokerage and all.
For example, a mutual fund,
Ah.
which is not impacted by capital gains, so that that constraint
Is not there to,
Is not
to
there.
you as a mutual fund manager.
as a mutual fund manager, but even then the impact cost will be quite high.
Okay.
And if I buy and sell it back, the impact cost can be as much as, I don't know, 2 to 3% or so. So which means that there is a reasonably high barrier of transaction cost that this benefit has to exceed.
Okay.
So which is why there is a bit of inertia that whenever there is a good quality business, which
Hold
is...
on to it.
Yes.
Okay. Now that weight, portfolio weight, should I remove that column completely from my portfolio tracker? Does it help me in any ways in taking my decision? Just because the stock has moved up, like when Warren Buffett bought Apple, it would be around 18-20% of his portfolio, if I'm right. And today it is 47-48, and he doesn't give a damn about it. So what is the right answer?
I think you should still be aware of the weight of a particular stock in your portfolio.
Because for you, so this is a question from an individual's perspective. For you as a fund manager, you have to be very, very alert to the portfolio weights. Okay. Because 10% is the cap, and the moment something crosses 5-6%, your compliance team runs after you, right? But for an individual investor, does it have any value whatsoever?
So it's still better to be aware of that. Why is that? From a risk management perspective, let us say if a stock has done very well, and that single stock accounts, like we are mentioning,
For a good weight of the portfolio.
let's say half the portfolio, then effectively the risk in the portfolio is a bit on the higher side. As long as the investor is aware of that risk, it is fine. I'm not saying that he should actually bring it down.
Right.
That is not
Just
my
be
point.
aware.
Yes, he should be aware of that risk which is contributed by that single stock which is accounting for now 50.
For the awareness, I think you should be lowering the rates in the portfolio. But other than that, I don't think.
Yeah, because any stock, sir, which was a good pick in, like, for example, and this is not a recommendation, my first stock was Bajaj Finance. Till
It is the biggest contributor to my bottom line in the portfolio. And because of that, naturally, if I've been holding onto it for a very long time, it is the biggest weight in my portfolio. But if I'm aware of it, I'll never let a multi-black bagger fly.
Very valid point. And if that awareness actually impacts the ability to hold on to a good quality business for a very long time,
Yes.
then that awareness is a
Actually,
handicap.
minus point.
Yeah, it's a
And
handicap.
then some random person looks at my portfolio, oh my God, this stock is 25-30% of your portfolio.
Yeah.
It can bring you down. But if we follow that particular philosophy, we'll never let a multi-bagger. Anything which is a multi-bagger will be a very big weight in your portfolio.
Fair enough. No,
And that is how equity returns are made.
Yeah, I take your point. So that there are pros and cons.
Then if I design a equity portfolio tracker, let's say I'm designing a portfolio tracker, I should remove that weight column completely. I also have other, let's say my daughter is a teenager, and if I want to teach her about investing, I am fed up of share price. I don't remember any share price of any stock. I believe if I have to teach youngsters, I want to make them think from a market cap perspective. The share price indicates nothing. Okay. Yes, you use it as a anchor to compare it with आपने कितने में खरीदा था, what was the average purchase price, what is the price today and all. But why can't you think in terms of market cap? And if I think in terms of market cap, then I know the turnover of the stock and I know the profitability. Automatically, my mind will do the math.
Absolutely. So effectively then you start to behave like owner of the business
Yes.
rather than just as a shareholder.
Which is required, right, sir?
Yeah, absolutely.
Which is required.
Yes, that facilitates that kind
So
of
I believe a
thought process.
portfolio tracker should do away with the share price. It's a stupid thing, right? A share with a share price of 50 rupees can be much more might have a much bigger market cap compared to a share price which is a 500 rupees share price. So it's a very stupid thing. Doesn't give you anything. Market cap, and then you know the turnover, and then you know the profit. So automatically price to sales, price to equity comes in your mind, and you can think logically about that company. When you're comparing it with the peers in the sector, you have all the data in front of you. Another, so long tail concentrated, if I'm an individual investor vis-a-vis an institutional investor. So Warren Buffett has very often talked about institutional imperative. So institutional imperative, for the benefit of viewers, is Hindi में इसको देखा देखी बोलते हैं और herd mentality. And sir, isn't institutional imperative very prevalent in the institutional money that is managed? Is it as prevalent as an individual? Like if 3 or 5 of my friends tell me we bought a stock, so most people who are not into equity market do not do research and all. They get swayed by, if you have bought a stock, we'll buy it. Most buying and selling, sir, happens around the coffee machine. Right? Unlike people like you.
Right.
So how prevalent is institutional imperative? How much does it affect? I know it won't affect people like you, but institutions are also foreigners. We see these people suddenly buying into a sector and suddenly selling it. Sometimes they might be right and sometimes they might be wrong. So herd mentality, institutional imperative, how prevalent it is?
It is quite prevalent, and it is very difficult to put a number to that. It is quite prevalent. And so what helps you not to fall prey to the institutional imperative or the herd mentality that you spoke about are 2-3 things. Yes. Or 2-3 things. One is that an investor should have a reasonably consistent investment philosophy. The philosophy should be both consistent as well as effective.
Just spend 1 minute on investment philosophy. You uttered that word a couple of times. If I'm an individual investor, what should be my investment philosophy?
Every investor will be much better off if he or she has even a fuzzy investment philosophy.
Okay.
It need not be very well articulated.
Okay.
Even a reasonably fuzzy investment philosophy is fine. And so where the investment philosophy helps you is when you are going through cycles in performance.
Okay.
The level of anxiety and uncertainty is much higher when you are going through a poor cycle. And that is where these investment philosophies help you serve as an anchor.
So for example?
For example, let's say I follow a philosophy of investing in good quality businesses.
Okay.
And I try to, in many cases, quality tends to be a subjective assessment. So I try to make this a bit more objective. Okay? So that is beside the point. The main point here is that I invest in good quality businesses. But there are some phases in the market where
they are out of favor.
Yes, such an investment philosophy will be underperforming the broader market returns. And in such time, there is, especially if you are an institutional money manager, there is a bit of pressure due to that underperformance. I think those are the times where awareness of this investment philosophy helps you through that slightly.
So this is equivalent to when you buy a stock. I read somewhere, just write on a piece of paper why I am buying this stock.
Right.
And then you keep revisiting that.
Absolutely.
Right? That helps.
Absolutely.
Do you still do it?
Yes.
You do it?
So we, of course,
it is all in a digitized form or...
Exactly. We do that. And the other thing I do is whenever I meet a company, so I do write the meeting notes, and then at the end of the meeting notes, I'll also append my views of the business after that.
At that point of time.
At that point of time. And when I meet that company sometime later,
yeah,
I go back to my past notes and then see what kind of views I had at the end of the earlier meetings. How did the actual outcome pan out?
Right.
Where did I actually not say go wrong, where can the evaluation of the assessment process be fine-tuned? So these are some of the pointers which
Right.
are useful, and because of putting those
Because you had
thoughts,
put it into pen and paper. Okay. Sir, it's time for turntable.
Nirav, you have been a very successful, influential advisor for the past 10 years plus,
15.
past 15 years. And you're
This is my 15th anniversary, sir. October 2008.
congratulations.
Thank you.
In Nagpur, you're also a key opinion maker. So I would like to know, while all of us are quite happy that 20 years India has done well in terms of equity returns,
Yeah.
in this 20 years, what has been the change in terms of investor behavior?
Okay.
What is the change in terms of the expectations,
Yeah.
both in terms of time horizon and return expectations?
Yeah. So that's a great question, sir. I've been in this chair for the past 15 years. I'm managing money for 1,100 families now. Okay. And they are spread across 27 cities in India and NRI clientele in 15 countries abroad. So it's only geographically I am situated in Nagpur.
Ah, okay.
But my whole world is my oyster. That was my philosophy day one. First time, so one is now when the market dips, I get a call from the investor, not to redeem, but to invest.
Oh, very
Yes,
nice.
Yes, and you as a CIO should be very happy to hear that. I get a call, sir, SIP बढ़ा दे, and I get a call, sir, lump sum डालना है, market गिरा है. 10 years back, I used to get a call, market गिरा है, तो क्या करना चाहिए? Second, I also get a call for profit booking. If we make, like right now, our clients CAGR return are very high, much more than what they are historically. So I get a call, do you want to do asset allocation? Second is, over the last 5 years, I've been able to convince client to move money. So earlier there was a rule written in stone, cast in stone, that real estate ka paisa real estate mein jana chahiye. Now I've been able to convince clients that if you sell real estate, it's okay to pay capital gain tax,
Right.
and put it into equity. So that financialization of savings and money is coming from property to equity. At least people are, earlier I wouldn't have even dreamt of talking that to a client. And clients' children who are coming are very smart. One set wants to go to FNO way, right, which is very risky. Another set is willing to listen to you. And it's easy for people like me to talk to somebody who's educated, vis-a-vis somebody who got the wealth, who had the wealth, but he or she did not have the education. Like today morning, I was talking to a client who are quite well-to-do. And he had that belief that if our businesses is doing well, why should I put money in mutual funds? We are giving better return than mutual funds. And I said, I counted him on 3 parts. Point number 1, how sure you are that your business is clocking. What you are saying is it is clocking, the CAGR return. Okay. Second is, even if your business is doing better than mutual funds, still as a diversification tool, you should be investing in mutual funds. Because if it is a business means it is a cycle, and there will be an upturn and there will be a downturn. And people are willing to look at financial planning as a, so I'm an MFI registered MFD, but if people take my suggestion and they are open to discussion, which was not the case earlier, especially the new generation.
Fantastic. So what you're saying is that the investor behavior has
Changed.
matured.
It is changing slowly and steadily. People have understood that we should be doing an SIP. People have understood that we should be asset light. Just like, unlike the earlier generations, which at first opportunity of some money, if they got a windfall, they would go and buy property and gold and all that. That is changing. That shift is happening. And people, like I have a matrix, sir, that the value of all the vehicles parked in my garage and my value of mutual fund should be 7 or 10x of that. Very difficult to follow. So I give that metric to my client, at least come 3 times, 4 times. And people are now listening.
I have one more question, Nirav. So, in the financial markets, many types of solutions are available for investors.
Yeah.
We have relatively simple solutions like equities and more complex structured products.
Yes.
And still, the jury is out about what is the effective returns that the
Yes.
complex structured products are given to investors.
Yes.
So, as the Markets have become more sophisticated.
Yeah.
As the investors have become larger in terms of their investable pool, how are your investors behaving?
So that is a challenge I am also facing. I believe simplicity is the key. If I cannot explain a product to you, I should not be selling that product to you. But the HNIs and the ultra HNIs, they have a thought process, Janki sir, that if I am investing more and more, and they all have a mental limit in their mind how much to put in mutual funds. They believe mutual fund is one product. And I keep telling them, when you buy gold in mutual fund, that is one asset class. When you buy equity in mutual fund, that is other asset class. When you buy debt in mutual fund, that is the third asset class. And when you buy international equity in mutual fund, that is the fourth asset class. So I am sitting here, giving you 4 asset classes, if not more. So don't look at mutual fund in one basket. Second, they have a thought if my employees, if my maids, if my drivers are putting money in mutual fund, and this I'm asking to all CEOs and CIOs. So it's not a product for me. Beyond a point, I should be complicated and structured, and then I should look at those products. So that is a school of thought. Till date, I have not offered that product, but because of market pressure, maybe I'll be forced to look at them. But I believe mutual fund industry, the kind of food chain we have, you as the manufacturer, I as a distributor, and my client as an investor, it is the most wonderful food chain one can think of. SIP and hybrid products give you ability to invest across cycles, and you can still compound your wealth. It is so transparent. I have access to people like you. I can anytime pick up the phone, talk to you. The fact sheets are so clear. I don't think there's a better product out there.
Fantastic.
And it's easy to exit and enter. Let's say I give a client a mutual fund scheme, it is underperforming. It is so easy for me to come out of a scheme and to go into another scheme across mutual fund. And I have 45 mutual funds and 2,000 odd schemes between 45 mutual fund schemes. Where do you get that kind of flexibility?
Let's hope more and more of your investors make use of this wonderful product much more effectively.
Sure. Janki sir, thank you. Thank you for your time. It was a pleasure.
Pleasure is all mine, Nirav.
And I hope we'll meet again. And congratulations for being promoted to the Chief Investment Officer. It was long overdue. And I hope I see you here in that chair 10 years down the line also. We need fund managers and great brains and humble brains like you.
Thanks for your wishes, Nirav. Thank you.
Pleasure.
Yeah.
Thank you, Janki sir.
Bye.
Yeah.